Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Oracle has been promising for a while that they're going to accelerate to double-digit revenue growth. And while that may still come, they keep pushing that out. They grew single digits again. And let's not forget, for Oracle, it's a mix. They're growing the cloud businesses very fast, but about 60% of their business is still declining.
There's going to be a wait and watch type of an approach where businesses and consumers will want to see how the new policies turn out, how the new tax rates turn out. So they're going to scale back, which will lead to a pullback in the market, in our opinion, in the first half of 2025. And then the second phase is going to be in the second half, where we'll get the trifecta effect: low rates, low taxes, less regulation. And that's going to be pro-growth, which is going to drive up equity markets.
Our expectation is that they cut 25 at their December meeting, and then they cut 4 times in 2025. But the market has really shifted to a much more hawkish sentiment, with only about 60 basis points of cuts priced in for 2025. So we think that's a bit overdone. So we're actually looking for yields to come down in 25, not by a lot, maybe to around that 4% 10-year yield level. But I think that there's just still a lot of speculation and a lot of unknowns heading into the new year.
We got 1 hour to go until the market close. So let's take a look at the major averages here today. Not much going on here with the Dow. We got a 7-point gain for the Dow here, up not even 0.1%. I guess we're just playing a little waiting game for CPI tomorrow. The S&P 500 down a little bit, not even 0.2%. The Nasdaq leading declines down about 1/4. But as you can see, it's kind of like been floating lower throughout the day. We do see a little bit of bright spot in small caps, which have been lacking a bid as of late. They're getting it back in today's session.
Small moves today, Julian. I think you nailed it there. And I think this is, some of this at least, is definitely wait and see. You do have key inflation data on deck, CPI, which we will search for clues and try to divine what the Fed's next move will be. Will they cut? Will they pause? But it is critical, because it does give our central bankers that last inflation data point ahead of the meeting. And then what's going to be interesting is what happens. I mean, if it's in line or a bit lower, do people think, okay, seals the deal, cuts coming? If it's a bit higher, though, does that introduce some more doubt?
I mean, the cut is priced in right now, we should mention. Just really quickly, too, I want to check on what's going on with the Nasdaq 100 right now, because the action in large cap tech is interesting today. And in a little bit, we're going to talk to an investor about how to play the Magnificent Seven right now. As we know, Alphabet getting a bid today after it introduced its new quantum computer. Even the thing doesn't seem to be coming to market for years, but that leap is enough to cause a little bit of a juice in the shares. We're going to be talking about this later too. But on the flip side, we got Nvidia down again today by about 3%.
The Alphabet news was interesting, not just the quantum chip, but it was interesting when, of course, CEO Sundar Pichai announces that on social media, then Elon Musk responds with a wow. Maybe that's part of what you see today. I mean, a 5% move is impressive there.
Yes, for a company that size especially. But let's get back to CPI, because we have more inflation data coming out tomorrow with that consumer price index, giving us a key piece of economic data ahead of the Fed's interest rate decision next week. For more on the state of the U.S. economy, not just for the rest of the year, but beyond, let's welcome in Torsten Slok, Chief Economist at Apollo Global Management. And of course, we should mention Apollo is also the parent company of Yahoo Finance. Torsten, always great to see you. Let's focus in the near term, and then we'll get to the longer term. Let's talk about CPI tomorrow, what you're expecting, and kind of what the implications are then for the Fed.
Yeah, the big picture here is that CPI peaked in 2022 at 9%. Now it's come down to 3%. And the Fed's target for where we're going is 2%. So we got from 9 to 3. And the big question, of course, is 3 enough, or do we need to get further down? The Fed has obviously started cutting rates, and as you just talked about, I agree that they will cut rates again next week. But the big question is with the CPI tomorrow that, well, there is some evidence in the last few months that inflation is beginning to move up again. And that's throwing a bit of a wrench into the narrative from the Fed, because that might imply that we're not going to get as many Fed cuts over the next 12 months as the Fed has been saying. So the short version of what's going on, in my view, is that inflation has come down a lot, but it's not quite there yet. And now the question is what the Fed needs to do, in particular with the economy still strong and some risk to the upside to inflation from tariffs, some risk to the upside to inflation from restrictions on immigration, and potentially also some upside risk coming from lower taxes.
As you said, Torsten, inflation has moderated, but as you point out, it's not where Jay Powell wants it to be. Can you try and model out, Torsten, when you do think inflation gets back to that 2% target and importantly stays there?
Yeah, that's very important, Josh, because the key question then becomes, well, what does the Fed need to do today to get inflation back to 2%? And our strong opinion at the moment is that they need to keep interest rates higher for longer. In other words, in bond markets, we will see front-end yields be more elevated than what markets are pricing as we speak. In other words, we only anticipate that they will cut next week, but then we also anticipate that they will skip in January, because now they need interest rates to stay higher in order to slow the economy down enough to begin to get inflation down to 2%. So that means that for private credit, for fixed income more broadly, yield levels will still remain elevated for at least the next several quarters in our view.
I guess the question is, and you basically raised this question in your outlook for 2025, is what is the Fed's effectiveness at this point? And one of the ways you illustrate that is simply by looking at a chart of GDP growth since the Fed began raising rates, and which in theory should have then slowed GDP and slowed inflation much closer to its target. And yet GDP has been stubbornly good, right? So I guess the question is, what good is the Fed at this point? How effective are they?
Absolutely. Look at the chart that you're showing here. GDP growth has been remarkably resilient since the Fed began to raise interest rates in March of 2022. In other words, this chart here is the reason why the S&P 500 has done so well. This chart is the reason why credit spreads continue to trade very tight, because the economy continues to do remarkably well. Why is the economy doing so well? Well, first of all, because during the pandemic, consumers and firms locked in low interest rates. Remember, in the US, 95% of mortgages are 30-year fixed rate. That means that when the Fed raises rates, it does not have much impact on homeowners. That's a dramatic difference, for example, to the UK, where when the Bank of England raises interest rates, it immediately has an impact on mortgage payments for homeowners. Likewise, in the US, we also have had a very strong data center boom. We had a strong AI boom. And we also in the US have still, even before we know what Trump will do, still have strong effects of the CHIPS Act, the Inflation Reduction Act, and the Infrastructure Act. And all these three effects have been very strong tailwinds that are the key reasons, to your point, Julie, of why the economy continues to do so well, and therefore why the Fed does not need to cut interest rates as much as they thought just 6 months ago. When
you look ahead, Torsten, you see this U.S. economy that's resilient, it's chugging along. What, when you talk to your clients, do you outline as sort of downside risks for that?
Yeah, this becomes very important, because I do think that tomorrow's number that we're getting on the CPI is very important, because if inflation tomorrow is a little bit higher, and the consensus is actually expecting both on core and on headline a little bit higher number, that runs the major risk, of course, that we in 2025 bring back the environment we had in 2022. Remember, as we all know, in 2022, interest rates went up and stocks went down. That meant that the 60-40 portfolio in 2022 underperformed dramatically. And the fear that one can have going into 2025 is that if inflation does go up again, and therefore interest rates begin to go up again, then of course the stock market will begin to sell off. And again, in that case, the 60-40 portfolio will not be doing very well. So we really mainly worry about whether inflation tomorrow will continue to show this steady uptrend that we've seen in the last 2 months.
One thing we've been talking about monetary policy, we haven't really talked about fiscal policy, Torsten, and obviously there's a lot to consider, from tariffs to regulation to tax cuts. What is sort of your base case? And on that last point, when it comes to tax cuts, do you think we will see not only an extension, but more tax cuts, deeper tax cuts coming in the next year?
No, that's right, Julian. This is really where we don't really know much at this stage, but we do know that the Trump tax cuts will run out, meaning the tax cuts that got implemented in 2017 will run out on the 31st of December in 2025. Remember, as we all know, in 2017, you saw corporate taxes come down from 36 to 21%. You saw household taxes come down from 39.6 to 37%. So both household taxes were lowered and corporate taxes were lowered. So the result of that is that something needs to be done on continuing the Trump tax cuts, or at least some version, unless we will get some significant slowdown in the economy. Other things, of course, that Trump has talked about on the campaign trail, he's talked about lowering corporate taxes for domestic manufacturers to 15%. So that's giving an additional tax cut to companies that produce domestically. So if that does come around, that will also be a tailwind to economic growth, which will add to the chart that we just looked at, namely GDP growth already being strong, and therefore add a tailwind to the economic outlook.
So when we talk about Trump, Torsten, you know, we talk taxes and deregulation. Of course, we also have to talk about tariffs, which is difficult, I would imagine, for an economist like you to model, because you're trying to figure out how much, you know, what actually will be the policy. How much is this is just negotiating tactic, negotiating strategy. But when your clients ask you, Torsten, about potential tariffs and its impact on the economy, what do you tell them?
Yeah, no, this is very important also, Josh, because what we do know, at least, of the three things that Trump has talked about, namely talked about not only tariffs, but also restrictions on immigration and also on lower tax rates for corporate manufacturers. All these three effects happen to have a lifting effect on inflation. So the conclusion and the issue, at least in terms of how one can look at what might be coming next year, is that if the main three areas where new policies might be coming is lower taxes, more tariffs, restrictions on immigration, it happens to be the case that the textbook would be predicting that all those things should be putting upward pressure on inflation. So if we already have, as we started out talking about, inflation still only at 3, not quite down at 2, and showing an uptrend in the last few months, then adding to that the risk that there might be some more modest upside pressure to inflation, that does, again, bring you to the conclusion that interest rates will stay higher for longer. As you can see in the chart you're showing here, we have seen in the white line inflation tick up a little bit more recently, and that is exactly the worry that is why the Fed probably will keep interest rates more elevated than, again, what the market is currently expecting. And that, again, means bonds and fixed income giving yields that are higher than what people are currently anticipating.
And Torsten, in addition to fiscal, in addition to monetary, one of the long-term trends that we've talked about all year has been the rise of AI. And I thought the point that you made in your note was quite interesting on this front, which is that you think that the U.S. is pretty far ahead of most developed markets when it comes to data center build-out and AI. Are we going to retain that lead, and how important is that then for our economic growth?
Yeah, this is really important. Have a look at this chart you're showing exactly here, that at the moment there is more data centers in the US than all other countries in the world combined. It tells you that there is a significant need for capital for long-term investments. Of course, in AI and data centers is one very obvious place, but across the board in energy transition, we also have the Inflation Reduction Act, we have the CHIPS Act. We might now have more, again, on the manufacturing front. Just today, Trump announced that anyone who invests more than $1 billion in the US, of course, will be very welcome. So there are very significant tailwinds to long-term capital projects, and therefore financing from companies to long-term projects over the next 20, 30 years to transform the US economy, not only on the AI and data center front, but also on the energy transition. That is what we and others have called, of course, and talked about as the industrial renaissance that needs financing and needs capital. And that requires long-term financing and long-term capital to get exactly more data centers and more investment in the US.
Torsten, a final question here. Now, if I was a viewer and I was listening, and I think, you know what, Torsten makes a lot of sense. I think we're higher for longer. What are some of the implications for the stock market, Torsten? You know, because if I believe that we're going to be higher for longer, do I avoid small caps, for example, Torsten?
Yeah, exactly. So let's add up all this to what it means for the stock market. So importantly, the challenge for the S&P 500 at the moment is that it's so highly concentrated. Roughly a third of the index is made up of the top 10 companies in the S&P 500. We all know how important Nvidia is and how critical it has been for returns this year. The problem for the small caps is that 40% of the Russell 2000 have no earnings. So that means that if rates are higher for longer, that means that small cap companies will continue to struggle with earnings and therefore not being able to service the debt servicing costs. So that brings you to the conclusion that if you have to be in public equities, the mid cap or S&P 400 still continues to look like the most interesting place to be, simply because the risk is too high when it comes to the large cap companies, because it's so focused on a handful of names. And for the small cap companies, again, in my view, the bubble in small cap is still growing and continues to be significant when you take into account the fact that, again, 40% of companies in the Russell 2000 have no earnings. So in public markets, sticking with the mid-cap companies is perhaps the best strategy. But when it comes to general asset allocation, rates higher for longer, of course, means that you could be cutting coupons in fixed income that can still, including in private credit, still give you some very interesting yields. So let me summarize that by saying I love the adrenaline rush from looking at Nvidia and looking at a Wednesday afternoon where they deliver on earnings, will they not deliver on earnings. But why don't I sleep well at night and get some nice cash flows that are treating, of course, investors very well, given where yields are and given rates are going to be higher for longer.
So you can have your adrenaline rush and still sleep at night. I like it, Torsten. I like it. All right,
Exactly.
It's great to see you. Thank you so much for joining us.
Thank you.
Shares of Walgreens Boots Alliance surging as the company is reportedly in talks to sell itself to a private equity firm, first reported by the Wall Street Journal. Yahoo Finance's Anjali Kamlani joins us now with more. And it's a private equity firm that owns a lot of retail.
Yeah, owns a lot of retail and a lot of clothing, really, is like some of its key. So it's an interesting mix because you've got a pharmacy in the middle of that mix. But of course, the official line from Walgreens is that they declined to comment on this news. We know that the talks are still going on. This is not the first time that Walgreens has been talking about a deal. This year has been pretty busy for deal rumors for the company, starting back in January when it was exploring a $4 billion sale of its specialty pharmacy Shields. Then in May, there was rumors about it exploring a Boots sale, that's the UK arm of the company, for $8.8 billion. Then there were discussions in August about the sale of Walgreens' stake in VillageMD. That's the service provider, healthcare provider, that has been a loss maker for the company and kind of weighing on its books. And then now the new talk of taking Walgreens private following suit of Rite Aid. We saw that pharmacy go private recently and delist. And so this could be the next milestone in the company story. Now, of course, the deals could fall apart. They have been sort of adjusting and deciding what the right strategy is. And we know that the CEO that was installed, Tim Wentworth, came in with sort of the unspoken understanding that this company needed a turnaround. It needed to find value and make sure that it was stronger and see what can be made of the company. Whether or not it gets spun off for parts or stays whole or some parts of it stay together, that's all still up in the air. Those are the questions. But it seems like this is where we are now for Walgreens. It is a story that needs to be told. It's a story that needs something interesting. And so that's where we're at.
So we'll see what happens. Anjali, thank you so much. Appreciate it. We're just getting started here on Market Domination. Coming up, shares of Boeing are flying higher today after the jet maker restarted production of its 737 MAX. We'll check in on a few trending tickers later in the hour. And at 3:30, it's the latest edition of Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stay tuned. Much more Market Domination still to come.
Yahoo Finance has been releasing its coveted annual Company of the Year award since 2014. We'll reveal a winner in the following categories: Company of the Year, Surprise of the Year, Product of the Year, and Comeback of the Year. Be sure to tune into Yahoo Finance starting December 16th for the big reveal. Trust me, you won't want to miss this stuff.
Is it time to pivot away from the Magnificent Seven? For more on how investors should be positioned among those mega cap tech stocks, let's welcome in Arup Datta, McKinsey Investments Head of Global Quantitative Equity. Arup, it's good to see you here on set.
Thank you for having me. My pleasure.
So you begin by saying, listen, maybe it's time for a slight pivot away from those Mag 7 names, Arup. What do you mean by slight pivot? How do you think through that, and why now?
I think both the words are important, slight pivot. I've been saying that actually for about a year, that if you have only been invested in those names, good for you in the past 10 years. You didn't have to be anywhere else in the markets. That was the best returns. But to me, that can't continue forever. These are dominant companies. Let's not have any way around that. So they're dominant companies. So I'm not saying this will end like the internet bubble stocks did. These are far higher free cash flow margin, far higher growth potential. They're pretty much monopolies in their business. But valuation seems stretched. So what I'm telling people is, with extra money if you have here, why won't you add to the beaten down asset classes like US small cap, emerging markets, international? I'm just saying beef that up, and that's why slight pivot. I'm not saying the M7s are overdone, because I understand what kind of businesses they all are. They're pretty dominant, not just in the US, the world over. But all I'm saying is, maybe the kind of dominance in stock market returns they've had over everything else, US, non-US, that delta over the next 10 years is hard for me to see compared to the delta they've had the last 10 years. That's what I mean by the slight pivot.
Is NVIDIA an exception within that Mag 7 group to that pivot?
Again, I would say we should own some of the M7, Julie. There's no question about that. We actually do own NVIDIA. Just to step back, I'm a stock picker. I'm an all-weather core style manager. I like to keep my life simple. When I say all-weather core, what I mean is I like to have value, growth, quality all in my process at the same time. Because I don't know which style will be in favor. The last 2 years have all been about growth. Usually when the Fed starts to cut rates, as it has since September, value comes roaring back. Has not happened here yet. So that's why I stick to an all-weather core approach, because I have all three styles embedded in my process. So where NVIDIA comes in is, I have NVIDIA on one hand, which is owned on a growth basis, because a stock like NVIDIA, one should invest on its growth metrics. It's a category killer. So long as it's a category killer, it's growth that will matter, not valuation. Whereas other stocks we hold, like Comerica, would be on a value basis. So that's sort of how the portfolio is. It has both the mix. So we still own a lot of NVIDIA, Julie, mainly because it's a dominant player. No one has yet got into that GPU area, server area, which they dominate. They have huge free cash flow margins. That's the one I was saying, very different from the internet bubble. Emperor had no clothes kind of stocks that were leading. It's a very different set of stocks that are leading. And they're spending a lot towards R&D. And they keep blowing out quarter after quarter revenue earnings. So while you have that mix in place, I would say it's not the time to avoid it. You should still own it. And that's why we still own NVIDIA, as we have for most of the last couple of years.
And even after the run it's had, which has been tremendous this year, you obviously still think, listen, valuation's compelling here.
Valuation is, as I mentioned, Josh, valuation here is overdone. It's expensive. But for a name like NVIDIA, let's put it this way, I have 100% to emphasize value versus growth versus quality of a stock. NVIDIA will be emphasized 50, 60% how it looks on growth. And in JP Morgan and Comerica, it'll be more 50, 60% will emphasize how it looks on value. So yes, the 20% rough weight we put to NVIDIA's valuation, that drags down our ranking. But the 50, 60% weight we put on growth is really dominant, and on that measure, we own it. So I'm not saying it's cheap, but I'm saying it's a bit expensive for sure, but there's a reason for it, and the reason's still in place.
It's interesting too, because your picks are pretty diverse between industries, because you are applying these different metrics. One you just mentioned to us, United Natural Foods, UNFI. It's a natural food distributor, right? So where does it fit in to those criteria you were talking about?
That's the beauty of quant, I would say. I've been a fundamental quant manager now, closing 32 years at the end of this month, all in Boston. That's where the McKinsey GQE team, which I run, which manages about 10 billion, is based out of. McKinsey runs 150 billion. So the beauty of quant is I rank 20,000 stocks every day and act on it. So UNFI, I mentioned to you, was, since we were talking before, our use of AI, machine learning in our process, those are all part of our process today, was not part of our process 10 years back. So those make up some component of how we pick stocks. And I was very happy to see when I woke up this morning that UNFI had a nice beat both on revenue earnings. Today, I believe, last I checked, the stock was up 25%. One of the main reasons, there are two main reasons we held it. One was valuation. It looked cheap on price to cash flow, traditional metric. But the bigger reason is we have a machine learning model that predicts revenue earnings of a company. And we were predicting higher revenue and earnings for UNFI than the street was. And it came through for us overnight. And this is a name in our US small cap portfolio where we have done very well over the last 5 years since we went live. But NVIDIA is obviously part of our US large cap portfolio. But that's the beauty of Quant, that many stocks. That's why we have 21 unique strategies we run, from emerging markets, small cap, to US large, to anything out there. Because we can model all of these, because quants don't go as deep. Because somewhat deep, but our breadth is huge.
Right, you do a big
and
screen.
that's why we can customize portfolios easily for clients and so on. And that's the beauty of Quant.
Interesting. Arup, thank you so much for coming in. It's great to meet you.
Thank you very much for having me.
Thanks. Now it's time for some of today's top trending tickers, sponsored by Tasty Trade. You can scan the QR code below to check out the best, worst, most viewed stocks of the session on Yahoo Finance's trending tickers page. First, let's take a look at Boeing. The company reportedly restarting production of its 737 MAX jetliner. That is according to Reuters, and the shares are bouncing by some 4.5%. Now, as we know, the company had a big strike that affected its production, and it hasn't restarted all of it, but the 737 MAX is now picking back up again.
Yeah, it has now fully restored operations in that complex in Washington where it manufactures the jetliner, obviously a priority for CEO Kelly Ortberg, remember, took over in August. There have been challenges for Boeing this year. We've talked about all of them, the strike, the slower production to improve quality after the accident earlier this year. Nice pop today, although as we know, the stock has just been crushed this year.
It has. And if you look at the tally thus far this year, in November, 49 gross jet orders in November, 14 cancellations for the year, 427 gross orders is what we have seen for Boeing.
All right, turning to SiriusXM, let's look at that one as well. Those shares sliding as the company's forecast disappoints the street. We're down about 12% in today's trade. The online radio service, they issued 2025 revenue forecasts that did fall short of estimates. Also did say they're going to undertake a new cost-cutting drive, looking for, they say, about $200 million in cost savings next year, Julie.
Yeah, and remember, this was part of Liberty Media, that the John Malone-verse, if you will, and spun off as an independent public company in September. Evercore ISI saying, following the close of that transaction in September, we believe this was an opportunity for the company to articulate its sharpened operational focus. That's a quote from a note from the analyst there. But the outlook's below expectations, the analyst says, and the stock sell-off doesn't seem like an overreaction to us.
Bloomberg reminding me that Warren Buffett's Berkshire Hathaway, largest shareholder in this one, 33% stake. The stock is down about 50% this year, but the Oracle sees opportunity.
At least for now, still in there.
Yeah. Coming up, it is the latest episode of Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stay tuned, more market domination. Still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. I'm here with Bryant Van Cronkite as Senior Portfolio Manager at Allspring Global Investments. And you got a couple of pretty diverse things that we're going to talk about today. Let's get to your buy. First of all, Graphic Packaging here. The stock is up about 20% year to date, $8.7 billion market cap. So I guess we would call it a mid cap stock, right? So let's get to why you like this one. So basically, the company sold off part of its business, and so you like sort of how the stability perhaps that brought.
I like the shift in cyclicality of their cash flow. It's a company that very few people know, but so many of us touch every day. They do packaging products for beauty, consumer products, staples, that kind of thing. And they recently sold off their cyclical non-core assets, which improves the quality of their cash flow stream, which ultimately creates stability in the future, which usually allows for a much bigger balance sheet ahead of us.
Interesting. Okay. And so also when you look at the pricing of that existing business, they're doing things differently. What did they change?
My experience is the best businesses in the world price for the value they create, not the cost to manufacture. And the pricing methodology for this industry has been around a third-party source that they didn't have control of. They're shifting off of that, and that shift will then, again, improve the margins, improve the ROIC, and give them a return for the value they create, but it also provides predictability to the end customers, which the customers will like as well.
And then also they've been doing a big CapEx project that they are wrapping up. What were they doing, I guess, first of all? And then what do they do with that capital that might free up once they're finished?
As the cash flow has improved and they generated more cash and then sold the non-core assets, they had a lot of cash come onto the balance sheet. And what we want our companies to do is to play offense, and they're doing that. They're doing it through a CapEx project to build a manufacturing facility in Waco that will give them the best competitive advantage, the lowest cost base, and which will allow them to have higher margins and better organic growth. We're almost through that project in 2025, which will then lead to much larger future free cash flow for the company. So they're playing offense right when they should be. This is setting up to be a journey that is undervalued today, but could create tremendous potential for future free cash flow.
And it's interesting because you sort of answered a question I had about the company in what you were just talking about, that they're building that facility in Waco. My question was going to be, do they import, right? Are they going to be subject to any of the tariff pressures, trade war pressures that we are looking at in the coming year?
That is constantly one of the concerns in the packaging space. Is there going to be an increase in supply that puts pressure on the supply-demand balance, which would be terrible for the company, but that's not the case. There's so few imports into this niche part of the material space, and so they're competing with other U.S., with other local companies, and the competitors, frankly, are concerned. They're concerned that graphic packaging is creating such a unique competitive advantage because of this investment in Waco that should they follow with another $1 billion or should they back up? And so I think supply coming in would be bad, but the odds of that seem very low, so pricing stability should win the day here.
Yeah, and I guess that's sort of the risk that you were looking at here, that the other competitors are considering doing that kind of a thing.
Always a concern, because it's a great little cottage industry here of packaging that they're in, but right now the setup doesn't look like it to me, and so what I see is a series of events, things they did that they control that will drive a much better future financial profile, and this risk seems to be one that I wouldn't worry about today.
I am curious, for their clients that they're providing the packaging for, is there any trade war risk there that will create sort of lumpiness in demand?
Their end markets are very diversified. Foods, beverages, beauty, healthcare, and so no one client is that significant. Of course, we want to see global volume increase. We want the consumer to be happy, spending money. And if we have concerns about the economy or if there's a triggering of a slowdown, that's not great for them. But their business is extremely stable. We'll see revenues fall on the margin, low single digits in that case, versus the rest of the market, which will be much more significant. So I think the stock actually outperforms if we see a little bump in the economy as well.
Interesting. All right, let's talk about the stock, or in this case, group that you think people should avoid. And we're talking here about regional banks, the KRE index, which is up quite a bit year to date. It's up, something like 25, 26% because of the outlook for rates. Well, the outlook for rates has been changing a little bit, but let's talk about the business cycle first of all. Why do you think they're vulnerable, and particularly maybe vulnerable versus larger banks, I'm assuming you're thinking about?
Right, so we're focused on small cap banks here, local banks, regional banks, and let's think about what we own. With Graphic, we own a really unique asset base. What does a bank provide? Banks provide necessary business, but it's a commodity business. You can go to this bank, that bank, and probably not care that much where you go. I think banks overall, when you think about long-term investing, the ability to compound value from a challenged competitive position isn't one that I like. And so I see valuations moving higher, which we'll probably talk about, but I don't like the asset base. Let's try and find a better business to buy and a better package.
Let's talk about those valuations. I mean, we just talked about how the stocks have moved higher, but the E is not, I guess, matching the P, if you will. And so we are seeing that the PE, or in the case of banks, price to book, whatever measure you use, is going up.
They're moving higher for a few reasons, some fundamental, some sentiment driven. So fundamentally, as the Fed is providing more support to the economy, we should see loan demand grow. We're seeing the curve steepen. It's a benefit for the banks as they lend money out. That's great, but I also see a lot of sentiment driving stocks, right? Is it the deregulation from the expected change in political regime? Is it the beta of these stocks in a growing economy, which people are more optimistic now as the Fed provides support? Valuations today suggest a higher ROE than I think is likely for these smaller companies that are still going to face the same headwinds of bigger banks eating their lunch over the long term. So valuations today look like a point where we might want to consider avoiding going into the space.
Let's talk specifically for a minute about the sentiment around this incoming administration and the assumption that it is going to benefit some of the small banks. Why do you think that is not true?
Well, Trump was great for banks regionally, local regional banks in Trump 1.0, but using the same playbook for Trump 2.0 doesn't make sense to me. Right? We're not going to have the major reduction in corporate tax rates. U.S. banks, local banks are all U.S. focused, so they have the best beneficiary of lower tax rates. If we have a small change in tax rates, great, but not a big change. Deregulation's nice, right? But the key to that is it's going to allow for mergers to happen. So the key to small cap bank stock selection is picking the one that's going to get acquired. It's a tough thing to do. Deregulation in the broader sense for the industry is going to accrue to the larger banks. They're going to be required to hold less capital. They're going to use that capital to do buybacks of their own stocks, invest in AI, invest in things that the small banks frankly can't do, which will just drive a larger wedge and competitive advantage. So the EPS growth plan or path that we saw in Trump 1.0 to me seems a lot less likely this time.
All right, so what could turn your goodbye to a goodbye in the case of the banks? It would be the Fed being, I guess, more aggressive with cuts.
At the end of the day, these are macro machines, right? Again, they don't have competitive differentiators to drive their success. So what they need is a big tailwind. So the Fed being very generous, cutting rates, pushing the economy higher. That's going to create loan demand. It's going to create less loan losses. It's going to have beta working for these companies. It's going to have value working in the market. That's all great for these companies. And that can be a tailwind for a period of time. But that's what you're buying. That's what you want to happen. That's what you need to happen for banks to outperform over the next 12 months, in my opinion. So if we get that, which I don't think we will, banks should work. But all else equal, I think it's a better place to put capital right now.
Gotcha. All right. Thanks so much for coming in, Brian.
Pleasure.
Interesting stuff. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern. Stick around. Much more market domination coming right up.
breaking news. A judge has blocked Kroger's $24.6 billion acquisition of Albertsons. And this is just crossing here, Julie. It's a decision filed in Oregon federal court Tuesday. U.S. District Judge Adrian Nelson does find in favor of the FTC. Remember, the agency had argued that this kind of deal, historic deal, would violate U.S. antitrust law. Big win for the FTC, big win for outgoing chair Lina Khan for sure. The FTC had long argued, listen, if this had gone through, it could have led to higher prices for consumers. It could have stifled wage increases for workers. The companies had argued back, listen, we need this to go through because we need scale. We have to compete not just with traditional supermarkets, we're competing with the Costco's and the Walmarts and, in fact, the Amazons. But obviously the judge decided, listen, that did not hold merit. She sides with the FTC in this one.
This deal was agreed upon more than 2 years ago in October of 2022, and they have been fighting to get this government approval ever since then. So this has been a long time in the making. Remember that the parties had tried to make some concessions, right? They said they were going to sell hundreds of stores to C&S Wholesale Grocers, which is the owner of the Piggly Wiggly chain. But you know what? The government said, and the judge said, that this is not enough. In the statement, or in the finding, the judge wrote, there is ample evidence that the divestiture is not sufficient in scale to adequately compete with the merged firm and is structured in a way that will significantly disadvantage C&S as a competitor. That was written by U.S. District Judge Adrian Nelson in this ruling. So I don't know what the plans are now in terms of any kind of appeal, or if there is even any room left to appeal on this, if they just want to move on after this 2-year battle. And to your point, if they are just moving on without continuing to work on this, how they are indeed going to compete, if indeed scale was the argument for getting this done.
I had read reports that at least attorneys for the companies had said, listen, the deal would probably be called off if the judge did rule against it. We'll see in terms of the statements they come out against it. I mean, it would have been truly historic. It would have been the largest supermarket merger in history. Judge sides with the FTC on it.
Yeah, 4,000 locations would have been the total here. So as you saw there, Kroger shares moving higher, Albertsons shares moving lower as a result of this. We will bring you more developments as we get them. In the meantime, more breaking news. Shares of U.S. Steel are sliding, now down more than 10% after Bloomberg reported that President Biden will finally block Nippon's $14.1 billion bid to acquire American Steel, the American Steel Company, U.S. Steel, that is, citing national security concerns. This, too, has been a while in the making, as we said, a $14.1 billion acquisition here. And this has been one that's also been going back and forth. It is not a shock. There were indications that Biden would block it. Also, President-elect Trump had said he would block it as well, angering some of the unions that were involved in all of this. But, you know, the CFIUS, the Committee on Foreign Investment in the United States, still has to give its recommendation to the president.
Yeah, and so Bloomberg citing sources says CFIUS must refer the decision to Biden. They give it a date by December 22nd or 23rd. To your point, Julie, this became a really hot political potato. Biden, to your point, has suggested, listen, he was deposed. Trump had said repeatedly he would block it. So maybe not too surprising here, although I saw the immediate reaction in the shares. You saw a drop. Bloomberg did get statements from some of the parties here. U.S. Steel spokeswoman telling him the transaction should be approved on its merits. Nippon Steel saying in a statement, it's inappropriate that politics continue to outweigh true national security interests. So, to your point, maybe not a huge shock in that the political players involved had made it clear which way they were leaning.
Right, but even so, and much like the Albertsons Kroger deal, U.S. Steel has said it would have trouble continuing to even be in business without getting.
It really represented a kind of lifeline for the company.
Exactly. Yeah. So we'll see what happens with it now, and if it can figure out another suitor or some other path forward.
All right. Keep an eye on it. Alphabet shares, meanwhile, they're jumping today after the company unveiled a new chip that it says is a breakthrough in quantum computing and emerging technology, thought to one day replace its conventional counterpart. So, what exactly can this new chip named Willow really do, and when could we see it in use? Joining us now is Corey Johnson, Epistrophe Capital Research Chief Market Strategist. Corey, it's good to see you. So let's get right to this headline. You know, Google unveils this new chip. The stock moves today, Corey. Is that reaction to the stock, is it justified in your opinion, Corey?
It's insane. I mean, so a product with absolutely no release date or any concept of what it could be used for with this product adds, you know, a couple $100 billion, $150 billion in revenue in market cap to this company. It has not created $150 billion worth of value, and there's no indication that it will. It's a neat science project, but it continues to be a science project.
Well, and so what do you think is going on here, Corey? I mean, you know, first of all, what is quantum computing, and why is there so much excitement around it?
I'm Dr. Science all of a sudden here, okay?
Yeah.
Well,
you are more than we are, I can tell you that much.
No, I've been writing about this and looking at this stuff for quite a while, and particularly in the last year, because there's been so much excitement about it in the last year. There have been some legitimate changes and developments in the field of quantum computing. But it's a notion of computing that is very different than the old von Neumann style, you know, sequences and chips that really still governs what happens in semiconductors, which is one process followed by another process, or parallel processes all sort of marching ahead to do the computational tasks that they do. And instead, these quantum devices work in multiple phases. So it's not on and off. It's not A or B or 1 and 0. It's multiple combinations of possibilities happening across multiple combinations of possibilities, sometimes happening in parallel. So the things that can happen in quantum computing are incredible compared to what can happen in chips. But it's not just faster. It's different. There are certain things that a simple chip on your phone or even in a handheld calculator could do faster than a quantum computer can do. But quantum computers, in theory, will be able to do incredible things. They'll be able to decipher the blockchain, perhaps, or create new types of ways to get through cybersecurity that cybersecurity can't even keep up with in real time. It could someday be able to do just incredible things that are hard to imagine here. And so the science has to happen long before a product can happen. But there's no sense that any product is going to happen anytime soon.
Would you, nevertheless though, Corey, would you expect this to lead to our next great sort of arms race in tech? Is everybody going to be dedicating a ton of time, money, and effort here? I mean, Alphabet, IBM, and NVIDIA, everybody in between?
Yeah, no, look, we see over $1 billion invested in the last year or so into quantum startups here in Silicon Valley. There's Quantanium raised $300 million. Some company called PsiQuantum got $620 million. Smaller startups at very early stages are getting, like Riverlink got $75 million. So there's a lot of venture money being put into this industry, as well as big companies like Google spending probably hundreds of millions of dollars, maybe more, to develop, again, these science fair projects that may someday, you know, look, out here in the streets of San Francisco, there are driverless cars, Waymos, right, patrolling the streets of the city. They don't go outside of the city, but they've gone from science project to reality. We've seen that happen in our lifetime. We've seen that happen in the last few years. There will surely be things like this in other fields of science. Maybe quantum computing will be one of these things. I think that's why you see these companies investing in it, but it's a long ways off.
Do we have line of sight too, Corey? I mean, there's not just the arms race here. You know, how dedicated, how enthusiastic, for example, is China in this tech?
We know that China is investing in a lot. There's been some scientific papers such that we can see coming out of China about this for quite a long time. And I think that there's a notion that this is like an atomic project where there's going to be incredible amounts of investment over long periods of time to try to get to the other side and a breakthrough. And so a development like we see in this Willow chip with the wonderfully named Willow, I assume it's named after my friend Willow Bay at the Annenberg School of Communications, a terrific dean down there. I don't know what else would be named after her, but why wouldn't you name something after her? But the progress with this thing and the marketing of Google behind it sort of offer the opportunity to bring a lot more interest in this science.
Corey's such a name dropper. I love it. Shout out to Willow over there. Do you think then for everyday investors, first of all, are there publicly traded outside of Alphabet ways for them to get in? And should people be doing that? I mean, or is there enough other kind of AI related stuff, for example, to keep your investments occupied for now?
I don't give investment advice, and so I wouldn't advise at your own risk, right? I mean, there's a pure play in IonQ, this company that's gone from a $2 billion SPAC IPO to a $7 billion valuation today on, I think, less than $15 million in revenue. There's obviously a lot of betting going on, as I mentioned, in Silicon Valley as well. But again, the notion that you can somehow do a discounted cash flow analysis of this increase in Google's value based on this scientific announcement in a really cool video is, kind of nuts.
What did you make, if anything, Corey, of the kind of back and forth between the big personalities here over this, between Alphabet CEO Sundar Pichai and Elon Musk? It was Pichai sort of introduces Willow, and then Elon Musk responds on social media, wow, and there's kind of a back and forth here, and we should do a quantum cluster in space with Starship one day. Anything to be made of that back and forth? It certainly got a lot of attention.
Right, the billionaire geeks conversation on X. Look, it's really neat science. But when I'm looking at it from trying to understand the business implications of this, there may be some someday, but I don't see any products coming out of this anytime soon. And so when I'm trying to evaluate the valuations of companies and the kind of products that they might create based on these new technologies, there's nothing here yet. Now, will there be someday? Well, we can only hope, but it's not here yet.
Corey, always good to see you and have you on the show. Thank you, my friend.
Thanks, guys.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all of the action. Following the closing bell, stay tuned for market domination overtime.
There's the closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jared Blickery to get you up to speed on the action from today's session. So let's start with the major averages, which took a tumble, or at least a leg lower in the last hour of trading. Remember we talked an hour ago, the Dow was a little change. Now it's down 0.4%, or about 151 points, and that is true of the other major averages as well. Although the S&P had already been heading lower, kind of drifting lower through day's end. The Nasdaq off about 0.25%. But another one I noticed is the Russell. So large caps and small caps both seeing that leg down in the last hour or so of trading here. The equal weight also off about 0.6%, and a lot of those losses coming in the last hour or so. Maybe people getting closer to CPI tomorrow morning and trying to hedge their bets. Who knows? Jared, what are you seeing in today's session?
Who knows, Julie? That's the second biggest catalyst that we probably have this month that we know about, the other being the Fed meeting. But let's take a look at the VIX here. We didn't see a lot of upward movement in the VIX. It still has a 14 handle, still relatively low by historical standards. We did see the 10-year T-note yield that jumped a little bit today, but only 2 basis points. Dollar was a little bit higher, but not seeing this big catalyst as to why we would have seen a reversal. And really, this is a 2-day reversal. I'm going to show the sector action for today. And let's take a look at that first. Here, XLC, the big winner, XLRE, that's real estate, the big loser. And XLC, by the way, it has Alphabet, it has communication services, it's the title of it, also has Meta, so it has some mega cap exposure there. Over the last 2 days, we're seeing just about everything in the red, and I'm going to be exploring this momentum reversal that we've had with Josh in about 30 minutes, so stay tuned for that. But suffice to say, this has been a 2-day pattern of reversals, only Staples in the green, and as we know, Staples is defensive. But let's get back to the day's action and check out the Nasdaq 100, then I'll send it back to you guys. Looks like Apple, that should be good for another record high. That has been happening a lot recently, and Apple has been defying the odds of the rest of the market. Apple has just broken to new highs and kept on chugging, as you can see there. That was a 3-month chart. Nvidia taking a bit of a tumble. Alphabet looking pretty strong, up 5.5%. I believe that's a record high. Let's put a 10-year chart. Looks like we don't have the intraday high, but we could have a record closing. Hard to say from that chart, but probably just missed it by a hair. Meta up 1%, Amazon down by 0.5%, and Tesla up 3%. Guys?
Thank you, Jared. Market is in a holding pattern here as investors wait on that CPI report and the Fed decision. But our next guest says the real catalyst for stocks in the new year will be tax cuts. Joining us now is Jay Hatfield, Infrastructure Capital Advisors CEO and CIO. Jay, always good to see you.
Thanks, Josh. Thanks, Jody. Great to be on.
So you raise your 2025 year-end target for the S&P. You go to 7,000, Jay, and that's after that red sweep we saw on Election Day. Walk us through why.
Well, it's really just arithmetic. So cutting corporate taxes is great for corporations. Not very insightful, but it's true. And it's also good for earnings growth of corporations because their growth is determined by their after-tax return on capital. So a lot of strategists come on and say, oh, well, I don't think earnings are going to grow 10%. Well, they normally grow 10% because if you retain 70% of your earnings invested at 15% after tax, that's 10. So it's built into the market, but if you lower that tax rate, then the growth rate goes up and earnings go up. And so if it weren't for a corporate tax cut, which we don't know yet, that bill is going to be problematic, we would just be in line with the street. The street's coming out 65, 6,600. That's where we would lower our target. So we'll be dynamic during the year like we were this year. We raised our target to 6,000 in June, which is working nearly perfectly. Even at the end of the year, it seems to be kind of coming back to 6,000.
So there is still the if around the tax cuts, though, right? So it seems as though most investors are assuming the existing tax cuts are at least going to get extended. We definitely have talked to some people who say, well, we don't know if we're going to get a cut beyond that. So how do you sort of game that out at this point?
Well, we originally had thought about a 7,500 target, so that's the 15% magical rate that gets thrown out there with some caveats, like you have to be a domestic company or something. But we think it's going to be difficult to get this bill passed. You know, it's reconciliation, which requires a balanced budget over 10 years, which you can play a lot of games with, but also this Congress, at least a portion of this Congress, is pretty worried about the deficit. So it's not going to be just an open book. So that is the big uncertainty of the year. And we think it's more important investors focus on that than tariffs or deportations or the latest nomination or other distractors. Just focus on this critical element, which is corporate taxes.
But you must get questions, I'm guessing, Jay, from clients when they ask you about tariffs. Well, are you in the camp that, listen, it's a negotiating tactic?
Well, that's part of it, but what everybody ignores, because this is a little bit of a talking point left over from the election, and a lot of the economists that are writing about this are Democrats, like Alan Blinder in the Journal. But what everybody ignores is you get proceeds from the tax. It's basically a partial VAT. So that's good for long-term growth and investment because you have a lower budget deficit or gives you firepower to cut corporate taxes. So it's actually, in the long run, a positive thing, and it doesn't really increase inflation from a technical perspective. Inflation is ongoing increases, which only really comes from the monetary sector, from increasing the money supply. It's a one-time hit, and that is going to show up a little bit in CPI, and it's not great for some consumers, to be fair. I'm not the biggest advocate of it, but I think everybody's missing that there's a long-term effect that's positive. Like if Trump came out and said we're going to have a 15% VAT and pay for a gigantic corporate tax credit and lower the deficit, that would be good. Of course, the prices would go up at one time, and people wouldn't be too happy about that, so it won't happen.
Let's talk about where you're looking right now, because I know one of the places you're looking is small caps, which sort of hasn't yet really been working, even though everybody keeps talking about it. And even earlier, we talked to Torsten Slok of Apollo, who said the problem with small caps is that they are not profitable, or at least a large proportion of them is not profitable. And if the Fed doesn't continue to really cut rates, that gives them sort of a slimmer margin for error in reaching profitability.
That's definitely true. As a whole, small caps don't borrow more money. But when we think about small caps, we have our fund is ZCAP. We don't invest in any money-losing companies.
Gotcha.
And in fact, if I was going to say one thing to investors who are just starting to invest, just follow that rule. Because it's
Don't invest in companies that are losing money.
Right. Like when I was an investment banker at Morgan Stanley, we wouldn't allow them to go public. It was sort of a better day of investment banking until they were profitable. It was a while ago, but it was better days. But because then you're as I mentioned, when you have profitable companies, you're stacking the deck in your favor because they invest their profits. When you don't, you're stacking it against you. And so, yes, I agree. The unprofitable portion of the small caps have not been doing well. But the best way to think about small caps are slightly cheaper value income stocks. They're a very low portion of tech. So you'll see, like when tech's doing well, small caps will be doing poorly and vice versa. And they tend to be correlated with our other funds, which are all income value funds. So we haven't done a great job of diversifying our preferred stock and other funds because they all trade together. Like they're all getting kind of smashed today.
You also have, Jay, what you call some indirect AI plays. Now, AI plays, everybody always just immediately goes to NVIDIA. What are some indirect AI plays?
Well, the easiest one, because you don't even need the AI, is all the investment banks. We focus on Goldman Sachs and Morgan Stanley. They're the biggest. They're our biggest positions in ICAP, our large cap dividend fund. But not just because of the M&A. Although this is probably the biggest change in antitrust policy ever. Because essentially you had an antitrust enforcement policy was that you can't do mergers, and now the Trump administration is likely to be very loose. So that's great, of course, for those investment banks. But there are definitely going to be AI IPOs next year, and that's going to benefit these large investment banks because they almost always, particularly Goldman Sachs and Morgan Stanley, get the lead management role, and that's, I know from being a banker, that's where you really make money. You make like half of the spread, so being a co-manager, you don't make that much. So they're really likely to have a great year.
Jay, just quickly, because I know this is something, Josh, you've been watching closely. Some of the appointments that we've seen in the Trump administration, though, it's not necessarily given that they will be anything goes on antitrust and everything gets the rubber stamp, right? So how are you thinking about that?
Well, I just think that it was so extreme. Like
that any improvement would
right.
be an improvement?
You could just pick somebody on the street and they would be way better. And you can see that in Silicon Valley, which is my hometown. If you lose half of Silicon Valley to Trump, you've done something really wrong. And you think about their business, they're okay, oh yeah, we'll pay some more taxes, they'll dodge it through capital gains, we won't mention that. But if they can't sell their companies, they can't run their businesses. They need to get realizations. So they were extremely unhappy about that antitrust enforcement. So really anyone will be dramatically better if they're just middle of the road, which they're at least going to be. So we're not so concerned about that appointment, just getting rid of the last approach, because it was the most leftist antitrust policy we've ever had in history. So as long as that's gone, it's going to be dramatically better. And like I said, we're not just focused on that. These AI, nobody seems to focus on it, but it's going to be AI IPOs. There has to be.
All right, we'll have you back soon. Talk
Great.
to you about all as
Good
we
to be on.
start to
Thank
get
you.
them. Thanks so much, Jay.
Thank you.
We got some calls of the day for you now, starting with Tesla. Shares of the EV giant getting a lift. Morgan Stanley increasing its price target on the stock and reiterating Tesla as a top pick. That, of course, is Adam Jonas over there at Morgan Stanley. And he says some really interesting things here. Among them, he doesn't think that the sort of Trump backlash against electric will last. He says in his note, if the U.S. wants to be a leader in autonomy, it must ultimately embrace electric mobility. And so he says, really, the U.S. doesn't want to get left behind in autonomy to China. And autonomy and EVs are sort of go hand in hand. So it's going to have to be favorable environment.
Yeah, it's also interesting how he talks about to his clients in the note how Musk has entered politics so aggressively, right? And how that, he says, has sort of expanded investor thinking around Tesla's fundamental outlook. Because his point was to his clients, there's all this excitement around AI and data centers and renewables and robotics. But he says Tesla in his conversations very frequently excluded from the potential paths of expression in a portfolio. And his point now is maybe Musk made a bet and made the right bet, and maybe that has some implications here. As he says, as he looks ahead to 2025 and over the next 4 years, we expect to see Tesla's total addressable market expand to far broader domains.
All of that said, by the way, his price target right now, what he increased it to today, is $400. The stock closed at $400.99. So it's already above where, in other words, even though he's an overweight, his price target doesn't imply any upside from here, which is interesting.
All right, turn to another one. Let's look at biopharma here, because Bank of America Securities resumes coverage of several large cap U.S. pharma and biotech names. Among those names is Moderna, which took a big hit in today's trade. Look at that, about 9% we trade down there. So this was part of kind of a broader note here. They reinstate coverage of a number of names. They talk about the broader space. They also talk about what they don't like, and they did reinstate Moderna as an underperform, saying tough time to be a vaccines company. Julie.
Yeah, they said there's just too many layers of uncertainty at present when it comes to Moderna. Part of it has to do with those COVID product revenues as well. And then the company also, according to the analyst, Tim Anderson over there, says high R&D spending at Moderna means it's burning cash. By the company's own guidance, it won't be cash earnings per share positive until 2028. And he says, we think it's actually 2029.
So they don't like this one. They do offer, though, some buy-rated names like Eli Lilly. They said should be a core long-term holding because, the analyst says, outsized durable long-term growth, many protective moats. So there's his buy. Time now for What to Watch. Wednesday, December 11th, sponsored by Tasty Trade. Starting off on the economy, we're going to be getting monthly CPI data. That's the Consumer Price Index coming in out at 8:30 a.m. Eastern. Economists forecasting core CPI to hold steady at 0.3%, while total CPI grows to 0.3%. The new inflation print giving us a key piece of economic data ahead of the Fed's interest rate decision next week.
Moving over to earnings, we got more numbers coming out tomorrow from Adobe and Macy's. Adobe will announce results for the fourth quarter after the close. Analysts expect artificial intelligence to be in focus during the earnings call, centering around generative AI and the monetization of text to video.
And sticking with earnings, Macy's reporting third quarter earnings in the morning. Macy's, remember, delayed its Q3 results, only reporting some preliminary numbers. It's coming after finding that an employee hid as much as $154 million in expenses.
Stick around, we got much more market domination overtime still to come.
Yahoo Finance has been releasing its coveted annual Company of the Year award since 2014. We'll reveal a winner in the following categories: Company of the Year, Surprise of the Year, Product of the Year, and Comeback of the Year. Be sure to tune into Yahoo Finance starting December 16th for the big reveal. Trust me, you won't want to miss this stuff.
Just minutes ago, a Washington judge, I believe an Oregon judge, blocked Kroger's $24.6 billion acquisition of Albertsons. The ruling a huge win for FTC Chair Lina Khan, who may only have weeks left in her job. But clearly, she isn't taking her foot off the gas. Joining us now with more Yahoo Finance's Alexis Keenan, because you've been sort of tracking Lina Khan's moves in her waning days on the job.
Yeah, so let's just address this decision here. It's a big one. This was a proposed $24.6 billion merger between Kroger and Albertsons. And what the Oregon judge, a federal district judge here, is saying is that they're issuing an injunction to, in theory, temporarily block this merger. But there was this case, okay, the plaintiffs here trying to block it. The FTC, along with 9 different states, all didn't want this to happen because it would have created the largest supermarket basically in history. And the FTC had set a hearing for December 18th in its own administrative case, but Kroger had vowed to terminate this merger if this judge in this Oregon case issued this injunction. So that seems like it will put it to bed. I suppose there could be more to this story. If combined, the market share would have been about half that of Walmart. So a big deal here. But certainly this is now going to be part of Lina Khan's legacy, right? Because this was a case that was brought by her FTC, and there are others still waiting in the wings that haven't even been been decided, haven't been brought to court yet. Those, in theory, will be transferred over to a new Trump administration. You have the FTC with cases also still pending against Facebook, Microsoft, and Activision Blizzard, right? Even though that deal was allowed to go ahead, that monster merger, the FTC still wants to undo it, and they have the authority to try to do that. Also now this Kroger-Albertsons case, which you're waiting for. But the FTC, it has a dual mandate to ensure not only that there's market competition, so the antitrust side, and it shares the responsibility for jurisdiction with the DOJ and antitrust. Also consumer protection, those are mostly fraud cases. But yes, taking a look at Lina Khan and what she has done under her tenure, this is certainly another stamp for her to have a big win in her pocket. Yeah.
All right, thank you, Alexis. Keep watching. President Biden, meanwhile, highlighting the strength of the U.S. economy in his speech at Washington's Brookings Institution by noting the state in which the new administration will be inheriting the economy.
Most economists agree the new administration is going to inherit a fairly strong economy, at least at the moment. An economy going through fundamental transformation that's laid out a stronger foundation and a sustainable, broad-based, highly productive growth. And it's my profound hope that the new administration will preserve and build on this progress.
Here with more on Biden's economic legacy is Yahoo Finance's Rick Newman. Rick.
Hey, guys. Well, Biden is right when he ticks off all the statistics about what's going right in the economy. He talked today, more than 16 million new jobs while he's been president, unemployment rate very low, and so on. We all know, however, that this is not good enough. This is the whole reason Kamala Harris lost the 2024 presidential election. There's one little problem. It's inflation. And the exit poll data from the election clearly shows that voters feel very burned by inflation. I think most economists would say, they do say, that the inflation that we had during Biden's term was mostly not his fault. Some of it, for sure, did come from that extra stimulus bill he signed in 2021. But that was only the fourth of four stimulus bills, and there were other big ones before that Trump signed that contributed to it. Nonetheless, it all happened on Biden's watch, and he lost, or his candidate lost, his party lost the White House for economic reasons. So I'm not sure Biden will be able to say, my economic legacy was really strong, given the fact that his party basically lost because of the economy.
Well, another part of his legacy, of course, were the investments, the stimulus that the Biden administration put into the green economy, right? And President-elect Trump has said that he's going to roll back some of that. But it's not entirely clear. I mean, for example, there was an interesting note on Tesla from Adam Jonas saying that any sort of backlash against electric vehicles, for example, will be temporary. What are you seeing in that broader green economy?
I've been doing a lot of reporting on this since the election, trying to figure out, is Trump going to basically roll back all the green energy progress that has happened under Biden? And I think the answer is no. Trump is not going to roll most of this back. Now, he is going to change some policies. I think that's very clear. He's going to be more favorable to fossil fuel companies, to drilling. He may cancel some things, some tax credits, such as those for electric vehicles. But the bigger story here, I think, is that the transition to green energy really has enough, really massive momentum at this point. There's a lot of inertia here. This is a global change it is going to happen across the world. You've got energy giants here in the United States, such as ExxonMobil and Chevron. They want to get in on this. They're benefiting from some of those green energy tax incentives. They know that fossil fuels are going to peak in, 10, 15 years, and that the money's going to be not in fossil fuels, but in green energy. This is a big and complicated story, guys. I have a story coming out on it. But I think if you're excited about green energy, I think it's going to keep going. I think that Trump might slow this down a little bit, but probably not very much.
I mean, the other interesting thing, Rick, is that many of the hyperscalers, right, the Alphabets, the Amazons of the world, Microsoft as well, they've made commitments to reach net zero by, whatever years, different years for different companies. And so some of this is driven by the private sector and the demand, the specific demands they are making on energy.
Yeah, so I think we're not going to hear much about net zero commitments for the next 4 years, and I'm not sure that is a bad thing. Net zero is a slogan. I mean, on one hand, it's a target. Net zero means you want to produce it. You want to be removing carbon from the atmosphere. At the same time, you're still putting some in, so the net carbon emissions are zero. We are not going to meet net zero targets that Biden set out or anybody set out. But I think under the most ambitious scenario, we would not be meeting those targets. What's going on here is there is a huge increase in electricity demand happening now and coming in the future. And this is because of AI and it's because of data centers. It used to be Bitcoin was driving all this. Now there's so many interesting things are happening in power, for example. You guys are gonna have to cut me off here because I'm just getting started. But there are data centers and AI operations that are going to Bitcoin mines and saying, can we buy your power?
Right.
We just want your power. We'll pay you more for your power than you're going to make by mining Bitcoin.
And
so
Bitcoin mines are saying
yes.
We
need every source of energy. And that is what's going to be happening for the next, it's partly Trump, but that's just what the economy needs. And that's what's going to be happening for the foreseeable future. So green energy is going to remain a big part of that mix and a growing part of that mix.
And we'll talk to you about it much more. So you don't get to talk anymore right now, but we'll talk to you more soon about all of this. Thanks, Rick. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
Don't go anywhere on the other side of the break. It's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Stocks sliding into the close, but it's not all bad news for investors. We've got to look at some of the big moves of the day and what you need to keep an eye on ahead of that CPI report. Plus, a read on the retail trader. We've got to look at the key stocks they're watching and talking about, especially on the heels of GameStop's earnings report. And the new trend in sports betting, going small. We're taking a deep dive into micro betting, and one analyst explains why it could be big bucks for the gaming stocks. Well, U.S. stocks closing lower as investors trod carefully on the eve of key inflation data. Yahoo Finance's Jared Blickery joins us here with the trading day takeaways. Jared.
We got to start with King Apple here, and guess what? Apple is the first company to reach $3.7 trillion in market cap. I know that was the hat everybody was waiting to wear, and let me just show you how this is shaking out right now. 3.7 and basically a half, PE ratio of 40, $247.77. And let me show you the chart, because Apple has been hitting record highs very recently, all of these record highs except for one or two in there, and this is impressive because we've seen a reversal. We're going to talk about that over the last couple sessions, but it's not just Apple, it's the Mag 7 overall with Apple as the leader. We can see over this 3-month chart that the Mag 7 has recently hit 5 record highs of its own. So for all the talk about the broadening of the rally and the small caps and everything, it's really been the big guys who have asserted over the last few days.
Speaking of big guys, what about Jensen Huang and his team in NVIDIA? What's going on there? Backseat?
Yeah, let's take a look at NVIDIA here, because since its earnings report just a couple weeks ago, it has really done a whole lot of nothing. Here we go. We had, remember the Darth Maul trade? Well, that was a spike to record highs, and it has done basically flat to nothing since then. And all of this reminds me of something that happened in the I believe it was the second quarter of 2023, but you can't see it in here real easily because it is such a distant price memory, but we spiked to record highs. Then we closed off, and we were just treading water for a few months. Could happen this time again. Fortunately, there are 6 other magnificent members there.
All right, Jared Blickery, point number 2.
All right, let's get to this. This is Momo reversal. This is the great momentum reversal that I've been talking about. And here I have something really interesting. I took the top performing S&P 500 stocks year to date as of today, actually. And here we're going to go with all of these. I'm going to show you the year to date performance, and lots of green on the screen, right? And if I sort by equal weight, you can see even the worst off here is up by 57%. I threw momentum in there, an ETF. We're going to get to that in a second, but the worst stock is up 57%. Now, check out what happens when I change this to a 2-day, lots of red. And for whatever reason, call it profit taking. Sometimes that's a lazy excuse, but I can accept it in this case. We're only seeing a handful, less than a handful of stocks in the green here. So for the most part, we have been seeing this momentum reversal over the last 2 days.
And do you believe, Jared, when you look at the charts, you think that is it's kind of a temporary blip we're seeing, or no, something bigger, broader is at work here?
Yeah, it's really interesting. I look at this ETF called MTUM, and it's rebalanced quarterly, so 4 times a year. It just rebalanced as of the end of November, and what I've noticed is, for whatever reason, the late November, the May rebalancing, sometimes we have seen whenever it takes those stocks that have done well over the last few months and says, we're gonna load up in these stocks don't work right away. And I think that's kind of what we're seeing here. So I think this is only temporary, to ask your very pointed question, but we'll have to see how this plays out in the coming days.
We shall. All right, final point.
All right, I think this has to do with Bitcoin. I really hope it does. And let's see. Oh, MicroStrategy, is it greater than Bitcoin? This is an existential question, and I'm not trying to get people to write letters, but please do anyway. All I'm alluding here to is the fact that MicroStrategy led the breakout in Bitcoin before the election. And let me just go to our crypto stocks where we're going to find MicroStrategy. I just want to point, this is year to date. MicroStrategy is up 500% this year, and let's put that 1-year chart on. But it has just gotten insanely volatile over the last few days. And then you have these ETFs, these single stock ETFs, where you can get twice the volatility in either direction, and that's just even more insane. But this right here, this is very hard to trade. Nevertheless, I like the way this is kind of setting up for a breakout of 350 to 400. And let me just dial this down to a 2-month chart so we can see that a little bit better. 350 to 400.
So I'm sure there are viewers watching this, Jared, right now who are saying, hold on, is Jared saying that trading Bitcoin is as simple as I just watch breakouts in Michael Saylor's company?
You know, I hope it does. I hope it is. Because if it were that easy, we'd probably make a lot of money very soon. I am watching this $350 to $400 price range just to see if there's a breakout there. And if history is any guide, maybe Bitcoin will follow. I think with Bitcoin at an incredibly important level, and watch out for false breakouts, but you get 2 days going in the right direction, I think we can run with that.
Thank you,
Hope that's clear.
Great to have you. And be sure to check out Jared on the Yahoo Finance podcast, Stocks in Translation. That's every Tuesday and Thursday at 12 p.m. Eastern. All right, GameStop third quarter earnings crossing the wires moments ago. The meme stock trending higher here after that report. And for more on what's trending in the meme stock space, I want to welcome in now Tom Bruni, head of market research at StockTwits. Tom, it is good to see you. I got to tell you, Tom, in 2021, if you told me spin forward 3 years, Josh, you're still going to be talking about GameStop, I don't know. I'd be skeptical, Tom. But here we are. They reported. They gave us the results. Walk us through it, Tom. What did you make of that print?
Yeah, big picture, not much has changed. Similar to the last quarters, we're seeing continual revenue declines because the core business of selling video games and software related to physical stores is struggling in the 21st century. So I think the balance sheet's in a good place. They've got $4.2 billion in cash. Every time the stock pops up on Roaring Kitty's tweets or some other catalyst, they're able to raise additional capital and shore up that balance sheet. But what they haven't been able to figure out is how to get the revenue side going. So they did report net income of, I think, 17 million or so. So they're in the positive. But to really see the stock get momentum, people are looking for it to accelerate that revenue or at least stabilize it.
Let's broaden out the conversation, because at StockTwits you will have kind of unique line of sight into what traders, what investors are interested in right now. When it comes to the meme stocks, the GameStops, Tom, how interested are they still?
Yeah, so I think it depends how you define meme stocks, right? The way we kind of look at it is anything with social momentum, right? You were just talking about price momentum with MicroStrategy and Bitcoin, but there's also a social momentum meter. How many people are talking about it? How many are following it? Because we find that you talk about something first, you do your research, and then you go out and make a purchase or a sale, right? So we're seeing kind of like the early signs of what people are doing in the market, and so when we see major divergences or upticks, we kind of flag that as major activity. But to your point, traditional meme stocks have kind of fallen by the wayside, and there are a lot of kind of 2021 meme stocks that are coming back from the dead, like PayPal, Square, stocks that saw massive disconnects between kind of their fundamentals and their underlying and their stock price back in 2021. They corrected massively, but now their core businesses have kind of caught up again, and we're starting to see some momentum there again.
How do you all gauge interest on StockTwits? What are you looking at?
Yeah, there's a couple layers. So the top level is simply how many search results do we get for we're ticker based. So if somebody searches Apple, they're going to land on the Apple stream and they'll see all the messages about Apple. So that's kind of the top level. The next level is how engaged are people around this stock? How many messages are being sent? How many bullish or bearish tags are on the streams? And then kind of the last layer is how many people are adding this to their watch list? And I think that's an important part because it allows us to see how sticky is this trend? Is this something that lasts 5 minutes and people move on from, or are they sticking around for the long term and trying to take a longer term approach toward a specific security?
Do you think those meme stocks, Tom, the GameStops, other names, in your opinion, do they sort of fundamentally change how Wall Street reacts, responds, thinks about retail investors?
Absolutely. I think to your point earlier, thinking back to 2021, a lot of people thought this was just a phase, and that is not the case.
For sure.
Retail has stuck around. We're seeing record levels of options activity, record trading activity. We've got Robinhood adding betting markets, so kind of like this degenerate economy of betting on everything, including stocks, is kind of taking hold here. And so I think Wall Street has identified this as something that's not going away, and so they're trying to figure out how to navigate it. So if you're a fund, you definitely don't want to be on the wrong side of a social trend, right? Like in 2021 and GameStop getting blown up. And then on the company side, it's actually super interesting. investor relations departments, PR people, they're trying to get their message out there to retail, and they're using platforms like StockTwits to engage with their community, tell their story, and really build a strong retail investor base.
Why, Tom, did retail investors as a group become a force at the time it did? I mean, you mentioned Robinhood there.
Yeah.
Is that part of the reason?
Totally. I think the democratization of kind of the technology, the research, the tools, and the right timing of us being locked in our homes and not being able to do much else was kind of like a perfect storm of things. You're seeing it with the Bitcoin ETFs and kind of crypto right now. Democratization of those kind of non-traditional assets via traditional vehicles has allowed this market to thrive. Just look, in January we had the spot Bitcoin ETF launch. Then we had options on those ETFs. I
meant to ask you about that and how much interest you're seeing on. I mean, we talked about the meme stock, but what about Bitcoin ETFs, altcoins? What are you seeing?
It's been quite explosive. So since January, the two highest months on our platform in terms of crypto-related symbols has been about 20%, both in March and November, for obvious reasons. But if you include Bitcoin-related stocks or crypto-related stocks like MicroStrategy, Coinbase, other exchanges, other names linked to crypto, it's well above 20%. So although we're StockTwits, we get a ton of traffic around crypto, and it's a great place for communities to form and really track what's going on in that market as well.
It's such an interesting generational shift too, Tom, because when I was younger and I was first getting into business journalism, right, I had these older editors there, and they were always saying, listen, the way you invest over time, Josh, is you get into the most kind of bread and butter, vanilla, low-cost index funds you can find.
Yeah, absolutely.
Right? That's what you were taught.
Yeah.
Has that fundamentally just shifted?
I don't think it has. The way we kind of think about it is, investors typically find the market through some of this exciting stuff, right? Like if you're just out of school and you got your first job, like everyone tells you to get your 401k and like index funds, but how many people actually do that? So usually your entrance to the market is your buddy made a ton of money trading a meme coin or GameStop or some other meme stock, and that's kind of your introduction to the world of finance. You step into it, you kind of learn, get your feet wet, and then we find what most people adopt is kind of like this core and explore type approach, similar to what happens on Wall Street, where you have your core portfolio of low-cost index funds, 75-80% of your assets are just kind of low and slow investing, and then you have 20% of your portfolio where you can swing for the fences. You can be a little more speculative with the options. So that's what we see a lot of our users doing, and again, we're a real-time platform, so we're for active investors and traders, and they're looking for their next idea, their next edge on our platform, and I think this trend is clearly here to stay. We're just trying to help investors do their best job.
Tom, great to have your insight analysis and have you on the show.
Thanks for having me.
Perfect.
Appreciate
Thank you.
it.
Thank you. Stick around. Much more Ask for a Trend right on the other side. Micro betting is becoming big business for sports betting platforms like DraftKings and FanDuel, with some estimates putting the growing market at 50% of all bets placed this year on mobile apps. Our next guest believes micro betting and the larger in-game betting trend could reach $14 billion by the end of the decade. Joining me now is Jordan Bender, Citizens JMP Senior Equity Research Analyst. Jordan, it is always good to see you. For the uninitiated, Jordan, when we talk about micro betting, let's start there. Walk us through what micro betting is and what are some examples?
Yeah, good to see you as always. So, the way that this industry was formed was parlays and legalization. So as we sit here today, 62% of the US population has access to sports betting. And then the introduction and really, appreciation of the parlay bet. So adding multiple bets onto one bet slip. Those have been the drivers of revenue 7 years into this industry. But as we look forward, what's to come? In-play betting particularly will be a growth segment for these companies, DraftKings and FanDuel, some of the larger sports betting companies. And as we dig deeper into that trend, in-play betting is an area that we think will be a major driver of revenue. Really what in-play betting is what is going to be the next pitch of a baseball game? In an NFL game, is it going to be a pass or is it going to be a run? And these are engagement tools. As revenue, is growing at a very rapid pace over the last 5 to 7 years, operators like DraftKings and FanDuel will look to micro betting and in-play type betting to drive engagement for leagues, for teams, for team valuations, and they're going to benefit through the rapid growth here.
And in-play betting, Jordan, how big could that become and how fast is it growing?
Yeah, so we estimate that the total sports betting market in the United States is going to reach about $28 billion by the end of the decade. Right now, in-play betting is actually a small percentage. It's, well, not a small, but 30 to 40%. And what I mean by small is in more mature markets, that number is closer to 70 or 80% of total betting. And the reason why it hasn't gone to mature level market status yet is because parlay style betting, which is traditionally, before the game, has seen rapid adoption. But again, as that starts to slow, as adoption of parlays starts to decelerate a little bit, you're going to see in-play betting become more prevalent. And we estimate that it's going to go from about 30 to 40% of betting up to about 50 to 60% of betting. If we take our $28 billion addressable market by the end of the decade, you can get to a number where total in-play betting, so from whistle to whistle, is about $14 billion. Kind of going back to the original question of micro betting, where does that fall into play here? That's a relatively younger, newer type of betting product that could reach up to 10% of overall in-play betting. As we look at the companies that are best positioned for this, DraftKings just acquired a company called SimpleBet. That's really to bring the technology in-house, the algorithms, the technology to drive in-play betting and micro betting even further. So as the large bellwethers of the group start to realize there's a large revenue potential in the coming years in in-play and micro betting, and you're starting to see capital allocated into that space, we think that's going to be an extremely attractive way to own the sports betting market in the coming years.
And Jordan, when we talk about in-play betting and the potential growth there, what are the risks, though, we should think about as well? For example, what if regulators decide, hey, we're going to start more aggressively looking into this area? Is that a potential risk?
Yeah, I think if we look at the recap from 2024, the underlying fundamentals extremely strong. Customer acquisition strong, cost per acquisition very strong. On the other side of it, we've seen a lot of consumer protection start to bubble to the surface. Regulators who just kind of pushed through sports betting in the last couple of years are now taking a look and saying, we kind of pushed sports betting through. How are we going to further protect people? And in-play betting and especially micro betting, these are rapid forms of betting per se. So this could be an area for regulated wallet that people are spending. This could be an area that could have a spotlight shined on in the coming years. The other example here is Minnesota doesn't currently have sports betting, but they don't actually want, they're looking at it this year, they actually don't want to implement in-game betting, for those reasons. I think that there's a little bit of a misnomer behind in play in the amount that you actually spend. But, as regulators look at this industry, I definitely think there could be some risk to that growth. And that is a risk to the overall thesis behind owning some of these companies.
Jordan, always good to see you on the program. Thanks so much for joining us.
Good to talk.
On this week's episode of the Yahoo Finance Podcast, Living Not So Fabulously, UBS Wealth Management Chief Economist Paul Donovan did not mince words when he explained how discrimination for the LGBTQ plus community erodes as economic strife rises. You can scan the QR code below to check out all the latest episodes, and be sure to tune in to Living Not So Fabulously Wednesday at 12 p.m. Here's a clip from this week's episode.
Whenever we go through periods of economic upheaval like we are going through today, or what economists call the fourth industrial revolution, there is a natural tendency in a very unstable, insecure socioeconomic environment to look for somebody to blame. And because the LGBTQ plus community has gradually acquired some rights over the last few years, that makes them a very easy scapegoat to blame, and that's what we're seeing come through now in queer economics, frankly, that we have a target painted on our backs.
For our chart of the day, how interest rates are impacting GDP growth, Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
How they're affecting GDP growth or not, as the case may be. This, of course, came to us via Torsten Slok of Apollo. And the chart begins when the Fed started raising interest rates, concerned as it was by the pace of inflation. Of course, when it raises interest rates, that is designed to bring down inflation, but it brings down inflation by also bringing down growth. However, if you looked at this chart and you took out the dates and you took out anything else about it and you asked, is this at a time when the Federal Reserve was tightening monetary policy? Well, somebody would look at this chart and say, no, you're still seeing a lot of growth on this chart. We're told that interest rate policy has, quote unquote, long and variable lags. That is, it takes a long time to make its way through to the economy to bring down inflation, and it happens with some variability up and down and not working its way evenly through different sectors. And indeed, that has very much been the case. Now, Slok's point here is that all of this means that rates are indeed going to be higher for longer because growth has been so persistent, and therefore so has inflation. This is what he told us earlier.
GDP growth has been remarkably resilient since the Fed began to raise interest rates in March of 2022. In other words, this chart here is the reason why the S&P 500 has done so well. This chart is the reason why credit spreads continue to trade very tight, because the economy continues to do remarkably well.
And again, that is why he thinks that the Fed is not going to be able to continue to cut rates, certainly at the same pace that it has been, because indeed we have had this growth that has proved to be remarkably resilient. We're going to find out much more, Josh, tomorrow morning when we get the consumer price index to see indeed just how effective or not the Fed's policy up till now has been.
And we will be watching. Thank you, Julie. Let's take a look at what's trending now after hours. Shares of General Motors gaining after hours after the automaker says it's exiting the robo-taxi business. GM saying today that it will no longer fund robo-taxi development work for its self-driving company, Cruise, citing the, quote, considerable time and resources that would be needed to scale the business. Taking a look at GE Vernova, meanwhile, as the company declares its first quarterly dividend of 25 cents a share. GE Vernova also announcing a $6 billion share buyback. Looking ahead to 2025, however, the company's revenue forecast coming in shy of Wall Street's estimates. Be sure to tune in tomorrow to Market Domination for our conversation with GE Vernova CEO Scott Strizek. And turning to Dave & Buster's, that stock is down double digits in extended trading after the company's third quarter financials fell short of Wall Street estimates. CEO Chris Morris also announced his resignation to pursue other interests. Chair of the Dave & Buster's board, Kevin Sheehan, will serve as interim CEO. The company has now missed revenue estimates on 7 of the last 9 quarters. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow for all of the latest market-moving stories affecting your wallet. Have a great night.